In recent weeks, the arrival of coronavirus in North America has wreaked havoc on the stock market, bringing with it fears of a sustained economic downturn, including talk of a possible recession. And while no one really knows how it will all play out, there are steps investors can take when faced with a volatile stock market. With everything that's going on, it felt like the perfect time to have this week's guest join us. A dividend value investor for more than 20 years, Kanwal Sarai is the founder and editor of the Simply Investing Report. At the end of the episode, stay tuned for a special offer Kanwal has extended to Maple Money Show listeners. Welcome to the Maple Money Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Our sponsor, EQ Bank, has partnered with TransferWise to give Canadians a better way to send money overseas. The result is fully transparent and remarkably quick international money transfers that are up to 8 times cheaper for EQ Bank customers. To find out more, visit maplemoney.com/EQBank. Now let's chat with Kanwal. Hi, Kanwal. Welcome to the Maple Money Show.
Glad to be here, Tom.
Right now, we're in the middle of a very interesting stock market. Things are going up, things are going down. I don't even know what it'll be like on the day we publish, but as we're recording this, it's been very interesting. I guess, first of all, what's your thought about what this looks like in the media and everything? Are people freaking out too much, or is this legit, or where are we at?
I think it's slightly overblown. Time will tell where things end up in the next 6 months. Nobody knows. And especially with the stock market, I don't know what the market's going to do next week, next month, next year. So it's difficult to say. I've got a lot of emails in the last 5 days from people who are freaking out and asking about, should I sell everything or should I buy everything? What should I do? What do you think is going to happen? So I can't predict where the market's going to go. I don't think anybody can predict accurately where the market's going to go. My approach is, okay, let's wait for the dust to settle a little bit before we do anything. And the other thing is, you want to be careful. Selling when things are low guarantees you're going to have losses. It solidifies your losses, right? Unless you bought something 10, 15 years ago and it was a lot cheaper then. But if you bought something a month ago and now you're going to sell it, you're going to solidify your losses. So people have asked me, well, how much money did you lose this week? Nothing. I haven't sold anything this week. I still have all of my stocks. So I haven't lost anything. So you don't really lose anything until you sell. So you want to be careful. So just my rule of thumb is patience, remain calm, wait for the dust to settle, and let's see where things pan out.
Well, that's a great point. I saw someone mention in a Facebook group that they admitted they were pretty new to investing. I think they said maybe 3 months. And hopefully they don't listen to this show. But they said they were pretty new to investing, but this week they pulled all their money out. They didn't say what that is. Maybe if they just got started, maybe it's not a big deal. But they said they're pulling all their money out because they believe it's going to go lower over the next couple of months. Mm-hmm. And I didn't respond to it, but my thoughts were that, wow, that's a terrible decision because maybe this was a decent amount of money. And to say they pulled all their money out, which could be the bottom, and maybe it'll continue to grow for the next 2 years or something like that. So now they've really locked in that loss, and they're just going to watch it continue to go up and waiting for some drop that may not come for years.
Absolutely. I mean, when it comes to investing in stocks, whether you're buying individual stocks or you're buying ETFs or index funds or even mutual funds, at the end of the day, you're still buying stocks, whether directly or through one of the funds. When it comes to investing in the stock market, and what I always teach people is if there's any money that you need in 5 years or less, let's say you want to buy a house or you want to go on vacation, you need to buy a car or anything, or children's education. If there's any money that you need in 5 years or less, do not put that in the stock market. Mm-hmm. Because in the short term, the market is volatile. And we're seeing that right now. It's coming down. We've had a nice 11-year bull run. It's been awesome for the last 11 years. And now it's coming down. So investing in stocks is a long-term. My approach is that it's a long-term strategy, right? This is money that's going to be in your RRSP, 401k for the American listeners, or even in a TFSA for 10, 15, 20 years, right? This is money you want to retire off of eventually. Yeah. So you got to take a long-term look. And when you look at the stock market returns over the last 100 years, you can see the stock market, it goes up.
Yeah, exactly.
If you look at it 6 months or 3 months or a year, it's going up and down, right? There's volatility. But in the long run, the market has done consistently well, right?
So with a market like we're seeing right now, I think it's the real test of people's risk tolerance. You can always say, oh yeah, I get all this. I know it's going to go up and I'm fine with that. And I want to go 100% stocks and I'm totally tolerant. People might be finding out right now that that's not always the case. So what's your thought about sort of knowing your risk tolerance? And maybe even before that, can we set up what is risk tolerance?
Risk tolerance to me is how much risk are you willing to accept, right? And it's very different from person to person. And there's so many factors involved. Do you have a day job? Are you self-employed? What's your salary? Does your spouse or partner have a day job and are they making six figures? How much money do you have saved up, right? For a rainy day fund, are you sitting on $5,000 or are you sitting on $80,000 or $100,000? All of those factors are going to make your own risk tolerance, how much tolerance are you willing to accept, very different, right? On a scale of 1 to 10. Somebody might be 10, I'll take any risk possible. I'm going to buy Bitcoin today, right? Versus somebody who's very conservative on a scale of 1. They don't want to see their ETFs, mutual funds, or stocks go down even $5 or $10. So to answer your question, risk tolerance is how much risk are you willing to accept? It's different for everybody. And this is what I tell all of my students. You're not able to sleep at night because you're worried about your stocks or ETFs or index funds or mutual funds, then I hate to say this because I'm a dividend investor for the last 20 years. I hate to say this, but if you're not able to sleep at night and you're freaking out even during the day, then you're probably better off putting your money in GICs and bonds.
Yeah.
Right. But then you have to accept that the returns are not going to be very good. Right?
Well, exactly,
how much can you get in a savings account these days? Right? But that's the reality of it. It's very different from person to person.
I think I go the other direction. I am apparently very tolerant to risk, but I'm concerned that maybe I go so far that it's more of a head in the sand kind of thing. I normally invest in ETFs, and that's great, but I do like to make the occasional dividend investing. And a couple stocks I was noticing this morning, Obsidian Energy and Alcana, I had bought at least 5 years ago. I kind of saw them going down in the past, but I really realized today that they're pretty much sitting at 100% loss. not exactly. These companies are still running, I believe, but they basically lost all their money. Now, thankfully, combined, it was only $1,500. So it's a bit of a little speculation into energy. I'm okay with a little bit of gambling money, if you want to call it that. So can you go too far like that? Like, is there sort of a don't go totally head in the sand and you still have to actually maybe watch your investments?
Absolutely. So there's a couple of things here. It's a great question. It's a great comment. Very sorry to hear about where those stocks are today.
I like to admit all my mistakes on the show.
Nobody knows where the stocks are going to end up in the next 5, 10, 15 years from now. But like you said, it wasn't too much money. So that's good. Yeah. So the way I like to look at it and what I've been teaching for the last almost 8 years now is you got to think of your savings or your investments in two different buckets. There's your core holdings, right? This is the money you expect to use in retirement. When you're done, you don't have a day job anymore. You have to cover all your expenses. And where's that going to come from? So that's going to come from your core holdings, your core investments. And so what I do is for the core holdings, I don't speculate at all. So I will not be buying high-tech companies or Tesla or Bitcoin or any of those, right? So that doesn't mean you shouldn't, so when people hear that, they figure, oh, well, Canwell's against all of these, tech stocks and Bitcoin and everything else, and he doesn't want to do any of that. For the core holdings, which is 85 to 90% of your money, should be in safe, reliable, in my case, dividend stocks. I have a 12-step process, the 12 rules of simply investing, and we go through, it's a checklist, and we go through the 12 rules. We can put a link up. I can send you the link. We can put it up on your site.
Yeah, we'll add to the show notes then.
Yeah, and if we have time in a couple of minutes, I'll actually go through the 12 rules. I'll tell everybody what the 12 rules are. So if a company passes those 12 rules, it is a quality company, and that's a company that belongs in your core holdings. And that's going to be 85 to 90% of your savings are in your core holdings because that's what's going to cover your living expenses going forward. The second bucket is the one, like you said, where you can speculate, right? And you want to buy some stock in Tesla or Facebook or Twitter or technology companies or even energy companies, then you can do that. Because if things go bad, that is not going to affect your lifestyle. It's not going to impact your lifestyle, and it's not going to impact your retirement. Now, when I talk about retirement, most people think 65. I have customers, clients who have taken the course. I have people who've retired at the age of 40 or 45, and they don't need a day job because their core holdings are generating enough income, passive income, that it covers all of their living expenses.
Yeah, and who wants to retire at 65 nowadays? That's not the sexy thing. It's all retire early.
Yeah, everybody's talking about FIRE, right?
Yeah.
So the sooner you can do it, the better it is for you.
So let's go back to that, the 12 points to look for. Again, I picked some stocks this week. This week when we're recording, this will actually air a week later, but on Monday, the market dropped. And that night, I set up some orders for 3 of the major banks. And there wasn't a whole lot. I didn't go through a nice 12-step list. I just knew these banks were at prices from about 6 years ago, and the dividend yield looked nice. That's about as far as I went. So I just moved some money out of cash. But what are your 12 steps that people should be looking for?
Okay. I'm glad you looked at the yield. You looked at the stock price and kind of looked at where it is today. So that's great. That's a good first step. And so here I call them the 12 rules of simply investing. Rule number 1, do you understand the product or service offered by the company? And that's just a general idea. You don't need to be an expert in what the company does. You just have to have a general idea of what they do, right? So how does somebody like Bank of Montreal, how do they make money? They're a bank. They offer financial services. They offer mortgages and investments, and that's how they make money. McDonald's is even easier, right? How does McDonald's make money? Right? They have restaurants all over the world and they sell food. So that's step number 1. So if you don't understand what the company is doing, like if you couldn't explain it to your grandmother or explain it to a 12-year-old, then you should not be buying that stock.
Yeah, that's when you get into the strange startup things and things you just don't understand at all.
Absolutely. Yeah. And remember, we're talking about the first bucket, the core holdings. Yes. This is your life savings in here, right? So you want to make sure they're safe, reliable companies that you're investing in. Okay, let's move on to rule number 2. Will people still be using this product or service in 20 years? Okay, so here we want to avoid companies that are fads, something temporary. Like the Rubik's Cube was a big thing in the 80s. Nobody needs them anymore. And the reason for this rule is it's very important. You want to invest in companies that are going to be around for 10, 20, 15, 30, 40 years. They're going to be around for a very long time because you're investing your hard-earned cash into those companies. So that's rule number 2. Rule number 3, does the company have a low-cost, durable competitive advantage or a lasting competitive advantage? The best way to explain this is to use, I'm going to borrow Warren Buffett's example, is to think of a company as a castle, right? So that's your corporation. And so what do you have around the castle? You've got a moat. And the deeper the moat and the wider the moat, the better it's going to be able to defend itself against competitors. So if you look at a company like Coca-Cola, they operate in over 125 countries all over the world. They've been around for a very, very long time. They've been paying dividends, I believe, for over 100 years. You can take that Coca-Cola logo anywhere in the world and just show it to somebody, and they immediately know what you're talking about. It's a soft drink. So if you were to start your own soft drink company today from scratch, think of how much money you would have to spend. Billions and billions of dollars in marketing and advertising. And you still wouldn't get to where Coca-Cola is today. Well, you might get there in 20, 30, 40, 50 years, but
not likely.
Not likely. So companies like that have a very strong competitive advantage because they've been around for a very long time. One other quick example. See, you got me talking about this stuff. So I'm so very passionate about this stuff. One other example, McDonald's. If you want a Big Mac, there's only one company in the world that can give you a Big Mac. And that's Coca-Cola, McDonald's, sorry, right? So you will cross the street and pass Wendy's or Burger King, even though they're closer to you, you'll cross the street and go over to McDonald's because that's what you want. So same thing with, other products and services. Okay, let's move on to rule number 4. Is the company recession-proof? So we only want to invest in companies that are recession proof. Again, remember, it's your hard-earned cash. You don't want to put it in companies. And we're seeing that right now. What's happening to the airlines right now? Normally, where there's a recession, a market downturn, let me ask you this. If there's a chance that you might get laid off from your job, are you going to go out and buy a new car tomorrow or next week?
Yeah.
Right? Of course not.
Yeah, good point.
You're going to keep the car you have, or you're going to start taking the bus. We don't know when recessions happen. Nobody can predict them. We don't know how long they last. So just to avoid that risk, we're only going to invest in companies that are recession proof. Think about it. Even if you lose your job, you still have to brush your teeth. You still have to eat. At night, when you come home, you got to turn the lights on. In the winter, you got to come home. You got to heat your home. And so the companies that are providing those products and services are not negatively. I mean, when there's a recession, all the stock prices come down. But these companies that are recession proof, they tend to have a bit of a cushion. Mm. They don't go down as drastically as some of the other companies do. So does that make sense?
Yep.
Okay. Rule number 5. Does the company have consistent earnings growth? Okay, so now we look at generally an EPS growth of 8% or more over the last 10, 15 years.
Okay.
And here we're looking, I'll keep it quick now because I know, like I said, I can keep talking about stuff. So we'll go through it a little quicker. So rule number 5, we're looking for companies who have a history of profitability. So we got to see the EPS going up year after year after year after year. If it goes up and down, and we had negative EPSs, just avoid it. I don't care how much you love the company. If it doesn't pass rule number 5, you got to move on to the next one.
So don't just look at the current EPS. You got to look at it over time.
Exactly. At least 10 years or more. And you got to look at it and see what it's... And the chart should go up. That's what it should look like. It should be a graph going up. Rule number 6, does the company have consistent dividend growth? And here again, we're looking for at least 8% growth over the last 10, 15, 20 years. So you want to look at the history and you want to see the dividend also. If you plot it on a graph, you want to see the graph line going up. And so this is important because this is your passive income, right? Mm-hmm. This is the money that's coming into your core portfolio. That's what you want to, eventually you want to live off of that. So a company that has a history of growing their dividend, I'll give you a very quick example, Tom. I hope you don't mind. This is, I love this stuff. For example, Johnson & Johnson, they have had 56 years of consecutive dividend increases. Okay, I'm going to say that again. 56 years of consecutive dividend increases. Okay, Coca-Cola, 55 years. Procter & Gamble, 61. So you look at companies like that, think about all the stuff that's happened in the last 50 years. Recessions, 2008, 9/11, all these things. Companies like these have continued to increase their dividend year after year after year.
Yeah, that sounds like a good way to make it a little more safe for people.
Absolutely. With all of these 12 rules, we're trying to minimize the risk, trying to minimize the risk to your capital. You work really hard for your money and you don't want to lose it. So that's what we're trying to do. One last thing before we move on to number 7. I can't predict the future. I don't know if Johnson & Johnson is going to increase their dividend next year. I don't know. But when I look at the history and they've had 56 years of consecutive growth, I have a high degree of confidence that they're going to increase their dividend next year. If not, keep it the same, at least, at a minimum. Right? So I have a high degree of confidence that'll happen. So that's important. Okay, rule number 7. Does the company have a low payout ratio? So we look at a payout ratio of 75% or less. So I'll give you a really quick example. Let's say a company had earnings per share last year of $1 and their dividend is $2. What's wrong with that situation?
They're paying out more than they're making.
Absolutely. The payout ratio is 200% or it's over 100%. It's bad. And you don't want that because so what's the company doing? They're borrowing money from somewhere to pay the shareholders to pay the dividend. So we look for a payout ratio of 75% or less. A good example would be a company that has an EPS of, let's say, $1 and the dividend is 50 cents. That's a healthy payout ratio.
Why would a company pay out more than they're making? Is it just to keep investors happy?
The short answer is yes. Temporarily, right? Like they're hoping their EPS is going to go up next year so they can cover it. And we've seen that in a couple of cases where companies have done that. So that's not a big deal. But if they do that consistently, 2, 3, 4, 5 years in a row, now you're looking at a problem where they will have to reduce their dividend or eliminate it altogether. Okay, rule number 8, does the company have low debt? Generally, we look at companies that have a debt of 70% or less. And the reason for that is, and there's companies out there today, I don't want to name any names, that have debt of like 500% or 600%. And that's crazy. So I don't care how much you love the company, you should not be investing in that company, at least for now, until they can get their debt levels back to normal again. And the problem with high debt is your interest costs alone are going to be so high. And when you get into a recession or a market downturn, which may or may not be happening now, based on what we've seen in the last week, companies that have high debt are going to have a very, very hard time surviving this market crash. They're going to have to cut their dividend. They have to eliminate the dividend. Worst cases, like we saw in 2008, companies actually went bankrupt. So again, we're trying to minimize the risk to you. So look at companies that have low debt. Rule number 9, does the company have a good credit rating? So we look at the S&P credit rating of BBB plus or greater. I can go into more detail, but we'll skip it for now. If anybody's interested, shoot me an email. For rule number 9, if you're looking at 2 different companies and one has a credit rating of D minus and another one has AAA, all things considered equal, invest in the company that has a AAA credit rating.
Yeah.
Okay. Well, that's all I'll say about that. Rule number 10, does the company actively buy back its shares? We're only talking about companies that are financially healthy. They have very good management in place. When companies like that actively buy back their shares over time, that reduces the number of shares that are out in the market. And what that generally, in the long term, what that does is it drives up the share price. So as an investor, it's always good. You want to be able to buy stocks and have the value of those stocks go up over time. And
why does a company buy back their shares? Is that just to own more of their own company again kind of thing? Or
Yes. And you're a great question. So there's a couple of reasons for that. One is to own more of to bring ownership back into the company. And the other reason is also the share price is going to go up over time anyway. And the other thing is companies that are doing this intelligently will generally time it when their own shares are undervalued. So that's always a good thing. Yeah, so generally it's to bring ownership back into the company. Okay, rule number 11. I love this one. This is my favorite one. I have never broken rule number 11 in 20 years. Is the stock undervalued or priced low? Okay, so this is the big one.
Yeah.
Everybody talks about buying low, selling high. Well, how do you know when a stock is low? So that's what we cover in rule number 11. It's in 3 parts, part A, B, and C. So part A is make sure the P ratio is 25 or less. B, you want to look at the current dividend yield for a company and compare it to its average dividend yield. So for example, BMO, I don't know what the yield is today, but let's say the current dividend yield today has to be higher than its average 10-year dividend yield, then the company is undervalued. And we go into a lot of detail in the course, and I actually teach you how to calculate that yourself, where to get the values. We don't have 2 hours on the podcast here, so I'll skip to that. But again, any questions, shoot me an email. I'm more than happy to answer those. But we do cover that in detail.
Yeah, and we'll go into the course at the end too, because I don't want to make you give away the whole course on this episode.
And then rule 11, part C, is the PB ratio, which is the price to book ratio, should be 3 or less. Again, all things considered equal, if you were looking at 2 companies and you got one company that's trading at book value or very close to it, and you got another company that's trading at, I don't know, it's $200 a share or something, it's way past the book value, then the company that's all things considered equal, the company trading closer to book value is going to be a much better value for you. I'll keep it simple. If the book value is $20 a share and the stock price is $21, that's a great deal.
Yeah.
But if the book value is $20 a share and the stock price is $195, not so much. Okay, so we got the last rule here, the last one. And the last one has nothing to do with financial data. It has nothing to do with looking at, charts and graphs or anything. It has everything to do with you, the investor. So rule number 12 is, and I know this one's very hard, easier said than done. Rule number 12, keep your emotions out of investing. And I know it's very hard, especially it's your money, right? It's your family's money. And it's easy to get emotional when, especially what we're seeing today and in the last week, and prices are coming down. You have to stay disciplined and you got to remain patient. And like I said earlier, this is the long term, right? If we're investing for 10, 15, 20, 30 years, we're investing for the long term. So always have a long-term perspective and don't freak out. If you buy a stock today and it drops tomorrow by $3, do not freak out, right? That's normal. Stock prices go up and down all the time. If you've done the 12 rules, if you've done your homework and you've invested in a company and it passes all the 12 rules, in the long run, you're going to be fine. Okay. So you got to remain patient and disciplined and disciplined that you follow the rules. They're not optional. So I have people sometimes emailing me and they want to skip one or two rules and they're not optional. You have to make sure a company passes all the 12 rules. Otherwise, move on to the next company.
Well, that's great. I love the 12th one because it brings it back around to this whole idea of this current market and what people can accept for risk. How does all this fit in the whole idea of diversification? Like, should we be with ETFs? This is simple. It's you get your different markets and get your stocks and your bonds and everything's very obvious. How do you do this with stocks compared to ETFs?
Yeah, great question, Tom. I'm going to say something and it's going to be controversial for some people, but I'm going to say it anyway, because this is what I believe and this is what I've experienced over the last 20 years as an investor. Over diversification can become a problem. There's a professor, George, I'm not going to pronounce his last name, starts with an A, a professor of finance at the University of Waterloo at the Ben Graham Chair of Value Investing. So he's got a great article where he covers about over diversification and how it's a risk for value investors. Again, I can send you the link. We can probably put it up there because this would lead to another 45-minute discussion about that. But let me summarize it for you. Okay. So when you buy an index fund, there could be thousands of companies in that fund. If you were to go out and buy an index fund today, for example, or let's go with today, there's 1,000 companies in that fund. We just went through the 12 rules of simply investing. Not all of those companies today are going to pass the 12 rules of simply investing. We talked about one of the rules about debt, rule number 8. And so all things considered equal, company A has a debt of 40%. Company B has a debt of 500%. Are you going to buy company B?
No.
Of course not. The debt is too high. So if you wouldn't buy it as an individual stock, why would you buy that company within an index fund?
Fair enough.
Second question, so not a question, but the second part is not all of those 1,000 companies in the index fund today are undervalued. Some of them are overvalued. Again, if we follow the 12 rules, I'm only going to buy companies that are undervalued today, that are priced low. I'm not going to buy companies that are overvalued. And believe it or not, there are companies today, even with the market crash right now, that are overvalued. And you should not be buying them. So if you wouldn't buy them individually, why would you buy them as part of an index fund?
So what are your thoughts on ETFs then? Like, I can see what you're saying, but at the same time, ETFs have to be a good choice for a lot of people because not everybody's going to sit down and go through the 12 steps. So
absolutely. Yes. So that's a great comment. Can I get back to that just in a second? Yep. So about diversification, here's the other thing. I find that I get enough diversification with the individual companies that I'm buying. And I'll give you an example. Coca-Cola operates in over 190 countries. Johnson & Johnson operates in over 60 countries. McDonald's is in over 119 countries. And surprisingly, the Royal Bank of Canada, RBC, operates in over 37 countries. Because I understand the reason behind diversification. Like, hey, if there's a recession in North America, maybe Asia's doing really well and Europe is doing really well, and I want to take advantage of that, right? Or, if there's a recession in Europe, but the US and Canada are doing really well, I want to take advantage of that. By having all of these international companies operate all over the world, they can take advantage of that. They can take advantage of, businesses really growing in Asia. We're going to make a lot of money there this year as opposed to in North America. We're going to transfer more resources to Asia. And, that's going to help drive up our profits and drive up the EPS. and then hopefully increase dividends, because that's what we care about at the end of the day. So I find by investing in these individual companies that are large companies, I'm already diversified geographically, right? And so that covers diversification. Okay, so now to get back to your question about, does it make sense for people to buy ETFs or index funds? And it absolutely does for some people.
Mm-hmm.
ETFs, index funds, are best for people who, A, do not have the time or the desire to select quality dividend paying stocks individually. That's one way to go. Number two, don't have the knowledge to select individual stocks. And that's why I created the 12 rules of simply investing. So to make it a checklist, make it easy for some people. But if you don't have that list and you don't know what the 12 rules are, and you're just going to randomly buy a stock based on the stock price today, well, no, you shouldn't do that. Then maybe, and if you don't have any desire to learn how to do that, then you're better off buying an index fund or an ETF. And the last piece is, if you don't have the patience or the confidence, or like we said, risk tolerance, sometimes it freaks people out to buy individual stocks and then watch the prices go up and down. And you're like, I can't believe it, I'm losing so much money. In that respect, I think an index fund ETF is going to be better. It's just certainly going to be better than putting your money in a savings account or a GIC for the next 20 years. There, I think it makes sense.
Or some of the mutual funds. When I first started investing, I thought I was pretty smart. I was a financial analyst just out of college, and I was like, well, I'm going to buy this mutual fund, and it's maybe 2%, and I'm going to buy another one, and the MER, and I'm going to buy another one. I'm going to get all diversified. And in the end, there was so much overlap that I was paying these huge management fees for very little value. So if someone's in mutual funds, I think definitely that there's a good case to move over to ETFs as soon as possible.
Yeah, absolutely. And I agree with you 100%, right? If someone's in mutual funds, move over to index funds or ETFs, the MER is going to be a lot lower. The other point I want to mention with index and ETFs, the MER is certainly a lot lower, right? So I was looking at a couple of them last week. MERs are like 0.03% or 0.06%, which is really good. What happens is, as your portfolio starts to grow and the size gets bigger, right? So if you're only investing $5,000, $10,000, or even $100,000, the fees are insignificant. But now when you get into, and I've done the numbers, I can send some numbers over to you. Again, this is a bigger topic. But now when you get into the $500,000 range or higher, or closer to $1 million, an MER in any of the index fund ETFs is still a lot of money. And it's going to come back and hurt you in the long run. But that's, again, it's for people who have a large portfolio, $500,000, $800,000, or $1 million. That's when those fees actually start negatively affecting your performance.
Yeah, the real dollars start to really add up, and it doesn't just seem like a small percentage anymore.
Yeah.
The other thing I wanted to cover is, to reduce risk, we always hear about adding bonds. Where do bonds play in with you?
Great question, Tom. That is an awesome question. If for somebody who is right now in their 20s, right? Because everybody what I always tell everybody is, you got to start as young as possible. So I got my kids started when they were 9. So both of them, my son and daughter, they took my course, they understand the 12 rules, and they each have their own stock portfolio. So my son started when he was 9, and then when my daughter turned 9, she wanted to copy her big brother, and so we did the same thing with her. So the younger you can start, the better off you're going to be. So in the case of my kids, or in the case of someone who's still in their 20s, if you're going to follow the 12 rules and you're going to build yourself a core portfolio of safe, reliable, dividend-paying stocks, there's no need for bonds, ever. Period. And I know that goes against what they teach everybody in school. And the older you get, the more you should put money in bonds and less in dividends. Can I give you a quick example of why I believe that to be true?
For sure.
Okay. I bought, back in 2000, I bought 185 shares in TC Energy. The share price was $13.40. So my total investment, $2,479. Okay, not a lot, but that was my investment. The dividend at the time was 80 cents a share. The dividend today is $3.24 a share.
Mm-hmm.
Okay, so if you take the dividend today divided by what I bought the stock at, $13.40, I am now earning today 24% return on my investment which was $2,479. That's what I invested. Every single year, 24% of that comes back to me in cash in the form of dividends, just from this one stock. Okay, that's incredible. Can I get 24% return anywhere from bonds, GICs, or anything? I can't, right? The stock has gone up to like $60, $79 or whatever, but I have no interest in selling that stock because it is returning to me 24% every single year. In fact, next year, it's going to be more than 24% because they're going to increase the dividend again. I don't know, but I have a high degree of confidence they will, because they've been increasing the dividend for the last 20 years since I bought the stock. So to me, this becomes kind of like a bond. And here's the other reason why. Remember, I invested $2,479. Guess how much I've gotten back in dividends since then?
Much more than that.
There you go. So I'm a money nerd. I track all this stuff. I've tracked it to the penny. So I have received since then from this one company alone, $6,134.60 in dividends alone. This is better than a bond. My capital has been returned. It's guaranteed. I'm not going to lose any money. The stock could go down to $2 tomorrow, and I would not lose any money on the stock. So the goal is, if you start when you're super young, and that's why I say even in your 20s, if you can start in your 20s, by the time you get to your 40s and 50s, you will be sitting on stocks that are returning you double digits, and they have paid for themselves in the form of dividends. So there's no need for bonds. If you haven't done any of this stuff and you're now in your 40s, then you need to get bonds, right? Mm-hmm. Then you got to follow the normal, I don't know what the norm is, 20% bonds or 80% stocks. You're going to have to do that because unless you can catch up, right? Unless you can invest, you're going to have to invest tons of money in your 40s and 50s to catch up. But if you don't have that and you don't have the salary coming in, then you will have to put a portion of it in bonds and GICs.
Well, it seems like bonds can probably help with some of that sleep at night as well.
Absolutely,
like even if you did start early and mathematically it doesn't make a lot of sense, it's still nobody wants to see their investments get cut in half over a market drop. So I get the math doesn't work, and I think you're the same as me, where we focus on real numbers a lot, and but there's probably people out there that would want the bonds just for that feeling.
Yeah, it gives you the comfort factor in there. Yes, absolutely.
Yeah. As you get older, I don't think anyone too young should worry about bonds, but I could see churning some of that into bonds over time. The other thing I wanted to ask you is this idea of dollar cost averaging. Is this something you recommend, or is it very tactical? Are we just sort of sitting on cash and waiting for the right purchase?
Mm-hmm. The big question I get, which is exactly the question you're asking, is the dividend reinvestment plans, right? So people ask, well, should I just sign up for a DRIP? And for those of your listeners who don't know, a DRIP is basically when the dividends come in, instead of you receiving the dividends, the company is going to reinvest into their own shares, and you're just going to get more shares instead of getting the cash. Again, this might not go with all of your audiences, and they might find it controversial. I don't do DRIPs. And I don't recommend DRIPs. And the reason for that is simple. If I've bought a stock, let's say it was undervalued at $50, and today the stock is trading at $100, I don't want to be dripping that stock because the stock is now overvalued. Remember the 12 rules. I only want to buy stocks when they're undervalued. Mm-hmm. And when you drip, you're inadvertently buying shares that are overvalued. So what I do, and it might not be for everybody, right? Again, it's your comfort level. How much time and effort do you want to put into it? What I do is I collect the dividends as they come in. And when I've got a substantial amount, I'm then going to go and apply the 12 rules and see which company satisfies the 12 rules today, and then invest in that company. So I am investing over time. Absolutely. In the course of a year, I might, 3 or 4 times a year, I'm going to go out and buy the stocks, but I'm not going to sort of drip them, or in the case of ETFs or index funds, it's every month, right? Every month, you just want to, regardless of what the market is doing, you just want to put in money every month, just because it's simpler, it's easier, saves you time. For most people, that might be okay, right? If that's your temperament and you don't have time and effort, it's automatic. It just comes out of your bank account every month and it goes into your ETFs and index funds. That's fine. I'm the opposite. I'm not going to be able to sleep at night knowing that the Dow Jones is at 30,000 points and it's overvalued and I'm buying stocks, right? So I don't want to be doing that.
And I should point out too, if you're using a broker, you can have the money go in automatically, but it can just go to cash. So you're still putting that money aside and waiting until you're actually taking a look at it and deciding how you want to spend that.
Absolutely. That's a great idea. The one last thing I'm going to mention is imagine a week ago, this whole thing started last Monday, right? So let's go back a week and a half. So a week and a half, you invested $1,000 into an index fund or an ETF. Well, everything's dropped now, right? Like, because the market was overvalued. We've had an 11-year bull run. We were breaking records every single year up until a week and a half ago. The market was going higher and higher. Remember, buy low and sell high. So you don't want to buy high. And so if you were investing even in stocks, right, or overvalued stocks a week and a half ago, you're going to see big drops in your portfolio today.
Mm-hmm. Well, this has been great. I think it's going to hopefully calm some people down, give them some ideas on how they can take advantage of this without putting themselves in any kind of real risk. Like if they're following those steps, they can find some great deals right now. When these things go down, I like to think of it as like a flyer sale. Like
That's right.
You're being told this thing is now 20% off. And so you can get in there and buy that. And it makes a lot more sense at that point.
And the dividend yields are going to be higher. So the dividend yields today are much higher than they were a week and a half ago.
Well, exactly. Yeah, that's a good way to lock that in and feel even a little more confident. Can you let people know about your course and where they can find you online?
Sure. On my website, simplyinvesting.com. So I've got the course there. It's very simple. I wasn't kidding when I mentioned that my 9-year-old took the course. They did take it because I want to make things simple, very easy to understand. There's no jargon. There's no difficult terminology. You don't need a degree. You don't need an MBA to take the course. So it's very simple, made it very easy for everybody to understand. There's 27 videos, modules that are broken up. And you've got as much time to take the course. You can pause things. You can come back and review it. It also comes with a workbook, comes with an Excel spreadsheet. We talk about how to figure out when a stock is undervalued. So we show you exactly step-by-step how to do that using the Excel spreadsheet. And I was going to mention, Tom, if you don't mind, for people who don't have the time to take the course or don't want to take the course and just tell me what to buy. That's all I care about. So I launched the Simply Investing report 2 years ago. So what I do in the report is I track over 225 stocks in the US and Canada every month. And I tell you exactly which ones pass the 12 rules and which ones fail the 12 rules. So you know which stocks to focus on and which ones to avoid and which ones are undervalued today and which ones are overvalued. So I do that every month.
Great. Thanks for being on the show.
Yeah. Thanks, Tom.
Thanks, Canwell, for your advice on managing the current market volatility and for sharing your 12 rules for dividend value investors. You can find the show notes for this episode at maplemoney.com/CanwellSarai. If you're interested in signing up for Canwell's Simply Investing course or his newsletter, he's offering Maple Money Show listeners a discount of 15% on both. Head to maplemoney.com/SI course or maplemoney.com/SI report and enter the coupon code MapleMoney15. And of course, you can find all these details in the show notes at maplemoney.com/show. And don't forget to tune in next week as Martin Dasko comes back to the show to discuss Airbnb experiences.